So let's finalize now. I've talked on margin. So the deposit required to open or maintain a position, it can either be free or used. Used margin is that amount which is being used to maintain an open position, whereas free margin is the amount available to open new positions. With $1,000 margin balance in your account and 1% margin requirement to open a position, you can buy or sell a position worth up to a notional 100,000. This allows a trader to leverage his account by up to 100 times or a leverage ratio of 1:100. So if a trader's account falls below the minimum amount required maintaining an open position, you will receive a margin call. So a margin call means you have over leveraged. Over leverage means the positions cannot hold any longer. That's why you hear a margin call, requiring him to either add more money into his or her account or to close the open position. Most brokers will automatically close a trade when the margin balance falls below the amount required to keep it open. The amount required to maintain an open position is dependent on the broker. So you need to understand that. So the broker and could be 50% of the original margin required. Then the spread, the difference between the sell quote and the buy quote, or the bid and offer price. For example, if Euro USD quotes reads 1.3200/03, the spread is the difference between 1.3200 and 1.3. So the difference here will be 3 pips. You can see there's 1.3200/03, and then there is 1.32. So the difference will be 3 pips. In order to break even on a trade, a position must move in the direction of the trade by any amount of the spread. So I think I'm done with this one. So let me also touch a little bit on this other PDF within the next few minutes. Then we'll be done with our training for today. So we also have Q&A. So you can type. Let me start you guys off. So there's Q&A. This session. Question and answer. Questions, then answer. So you can type any question you have, then I'll be able to respond as we finalize on our training for today. It was more of introduction, so I couldn't have given you more. So Forex market is the trade arena which allows investors to trade foreign currencies. We say this is over 7.5 trillion every day. It is active 24 hours a day. We are just doing a recap of what we had done. So the advantages, chapter 1. So I'll also be sharing this material with you on WhatsApp for those guys who are really serious about this training. So let's continue. So the value of the currencies changes every moment throughout the day according to supply and demand. The Forex market is the most secure medium investment in the world in comparison to other channels with a risk factor, such as stocks, options, bonds. So I'm just going through what we had said. Just in a regular market, we buy and sell vegetables, and in the stock market, we buy and sell stocks. So now in the Forex market, we are doing what? We are buying and selling currencies. So this is our product. So I need you to understand the major product we have in this business is the currency. There are more than 100 currency pairs in the world which can be traded. Okay. So currency exchange rates are uniform throughout the world. If the exchange rate of the euro in relation to the USD is 1.5220, and it will be 1.52 in Congo, New York, Australia. So you can see the exchange rate is the same, whether you're in London, Congo, New York, Australia, or Hong Kong. It is largely composed of speculators. Speculators are people like me, or perhaps you, who buy and sell currencies to profit from the change in the exchange rate of a currency. Only 5% of the transaction are for real purposes of commerce, such as industry, tourism, etc. Remaining 95% are speculation. Speculation, the reason we are doing speculation is so that we can make money. It's a zero-sum game, and the total gains are equal to the total losses. What affects the market? The Forex market is only affected by macroeconomic data, not by micro. So I need you to understand this, because I'll be giving you a quiz if you continue with the training so that you have it. So what is macroeconomic data? Raising of the interest rates in a country, the unemployment rate of a country, and political conflicts. So if a country is not very politically stable, you will realize that the currency is losing. If a country is politically stable, the currency of that country will be gaining more often. Of course, you're creating more jobs. On the other hand, microeconomic data are the balance reports of a very large company in the country, a large business deal which a large company is about to execute and or has executed and more. The microeconomic data does not interest excuse me the forex market and does not affect it. In other words, it is affected by large scale and international events. So these ones I'll be handling during fundamental analysis. It also comprised the model is comprises of currencies and commodities. Today, some brokers also allow trading of indices, futures, contracts, and certain stocks. All strategies and technical analysis you will learn here are relevant for currencies as well as for commodities. Commodities are things like gold and silver. Before we learn what an exchange rate is and how we buy, let's understand what are the advantages. We had done this, so I'm just passing through. Mm. Let's first understand the two principles or the advantages of forex. We talked about liquidity when we were beginning on the other PDF, or when we were starting. I talked about liquidity. Have you ever bought a stock and could it sell it at a specific moment? You have bought a particular stock. The stock had risen. This is an example greatly in only a few months, and all of a sudden the CEO resigns. At that moment, there was a pause in the trade which lasted a few hours, and the next day the stock decreased. The reason why it decreased, maybe this was bad news for that company. So you realize that there's a decrease in 10%. You are stuck with the stock. What are you gonna do? And you had bought the stock. In the forex market, there is no such a thing, because now you have to look for someone else who will be willing to buy that stock. If you have euros, pounds, Swiss francs, or any other tradable currency, you can sell it at any point in time. You'll never get stuck with a currency, and this is a great advantage of currency trading. As traders, it doesn't matter what you buy. What important is that at any moment you can cash in your goods, there will always be a buyer. There's one very important rule to remember. Until you cash in your goods, there's no knowing whether you have gained or lost. The second advantage is in the forex market, there is no control by external financial bodies. You speculate whether the market is going up or down. It's very hard for anyone to really manipulate the market. Central banks intervene only in the trading once every decade and are successful in affecting the value of the currency by a total of 2%. A movement of this kind only lasts a few hours, and then the exchange rate returns to its natural price. That's during the exchange rate. So like this year, we're expecting the Fed to cut the interest rates. I'll be explaining that later. So this goes to say that currency trading is fair, and nobody, as large it may be, can affect the market. So nobody can influence where the market is going. On the other hand, in case a stock or option, the large broker has the ability to inject tens of millions of dollars, and doing so, they can change the price of a stock. So this is usually called price manipulation. So, and unfortunately, when they do that, if you had bought or sold, it can affect you. So what advantages do we have in a market which is influenced by macroeconomic data? First advantage, it is much easier to follow and trade due to the availability and minimum amount of data. For stocks, for example, there are many factors which must be followed. Imagine that you own 45 stocks in the New York Stock Exchange. Let's assume you are serious investors, not gamblers. You have to know who the shareholders are, in what the balance sheet looks like, the gains and losses report, internal information, such as, for example, resignation of an executive, a large future contract, and so on and so forth. One must know so much information that following them on a daily basis would require many hours each day. In the forex market, there are 5 to 6 significant data in a month. The firm through which the firm through which you trade will provide you with this data in real time, and you, with the knowledge of that, will trade accordingly. Do you understand that signifies 5 to 6 pieces of information? So you have very minimal data. That's what I'm trying to explain. And then the second advantage, the important information reaches everyone at the same time. Let's assume that I'm a marketing manager of a large pharmaceutical company, and I'm on a flight returning from China, and in my hands in a close contract with the government of China, a contract which is expected to increase the profitability of the company by 100 billion USD a year. Who knows about the deal? It's only myself, the CEO, his wife, and probably our brother. And they don't know anything, and they don't do anything with that knowledge, right? Laughter. Anyway, until it is reported in the news that a huge deal took place in China, there are people who already know, who have made use of it, and the price of stock already reflects the news. You will be in the second level of decision makers. I hope you have made that decision. I mean, you have understood. Haven't you had? Ever met someone who told you that he or she bought a specific stock based on insider information and the next day it rose by 20%? Yes, yes, it does happen. You can go look at a movie, it's usually called Billions. You'll be able to understand what this information is all about. In the global foreign exchange market, when the American Federal Reserve Governor publishes a decision to increase the interest rates, the whole world knows. So we are able to have something we call leverage. It's like a referee. We can be able, whether you have 100 billion or 10 billion or $250, everyone gains the whole information at the same time. The whole world knows in the exact same second and can respond immediately to buy or sell the dollar. There's nobody who has insider information beforehand and who can make use of it in an unfair manner. Good. Make market research and analysis. The two main approaches for analyzing the movements in the forex market are the fundamental analysis. This is very, very important approach, and the technical analysis approach. So the fundamental analysis focuses on financial and economic theories as well as political developments to determine the forces of demand and supply. While the technical analysis focuses on price levels and trade volumes, from this data expectations are formed for future events. So basically technical is a way of charting, while fundamental is more or less financial and economic theories as well as political developments. These are forces, this is what forces demand and supply. Because for a currency to buy or sell, there has to be forces of demand and supply. That's what we'll be gaining or we'll be understanding while trading. The main difference between technical analysis and fundamental is that fundamental analysis concentrate on the causes of movements in the market, what is causing the price to go up or down. Whereas, this is very, very important. Note this, even if you don't remember anything, remember this today. Whereas technical analysis concentrates on the effects. So this one is the cause of the movement, and this one is the effects of movement in the market. Okay, so I'm almost there. Oh yeah, I'm even done. So there's an exercise here. We'll be sharing this PDF with you. You'll answer these questions. So this will be later, then you'll forward tomorrow in the answers. Then with this, I'll be able to know if you have understood. It's more of a quiz. You can see chapter 1. Then on the next class, which will be tomorrow, we can be able to start on the other one. So we'll be on time. Sorry about today. There was a little bit of a technical hitch, but at least we have sorted that out. So this will be shared with you. Then tomorrow we'll start with chapter 2, and now I'll introduce what is technical and fundamental analysis. So you can see this is chapter 2, elementary concepts of the forex market. So I also gave you terminologies. So now we'll be using them in real sense. So now, until now I need you guys to ask any questions. The sense of having knowledge is having it to apply it, not having it to confess your ignorance. Configures. So any questions? I think you're all gone. I'm only having my Yoto. So I'm almost running out of time. I think I have 5 minutes now. So any questions? Any questions? So we have 10 minutes. I'll be waiting in case anyone has questions. Then I'll also give Maureen to introduce. Naona ni kama hayupo. Kama ametoka. Tumalizie.
Yeah, many people too.
Mimi na yeye. Oh, can you talk about leverage? I didn't get it clear. Yes. So let's go back to leverage.
Ukimaliza you can finalize the class, then we'll have another class tomorrow.
Okay. So leverage, let's go back to leverage. Leverage is here. So leverage, let's go back to leverage. Higher. Here it is. Leverage, let me go slowly, is the ability to gear your account into a position greater. The word is greater than your total account margin. For example, you have $1,000 and you're margining this account and you open one lot. One lot is equivalent to 100,000 units. But you cannot open that lot when you're on your MT4 without something we call leverage. So what is leverage? Let's go down here. Leverage basically is being able to open a position greater than your account balance. Does that make sense? Being able to open a position greater. So if you want to leverage more and have $1,000, but I want to open a position of 100,000 units, which is one lot, I will need to have more leverage. This leverage is equated to, for example, 100:1. That means I'm having 100 times more. If I'm having $1,000 and I'm having leverage 1:100 or 100:1, that means I'm having $1,000 with 100 times more. I hope that makes sense. 100 times more what I have on the account. So if I have 1,000 and I'm having 100:1, that means I'm having 100 times 1,000. That's 100 times more. So that way I'll be able to open a bigger position, which can be able to help me make more money in the market. I hope I'm making sense. So if you open $200,000 position, this is a two lot with 1,000 margin in your account. This leverage will be 200 times or 200:1. That means if I'm having 200:1, I'm having 200 times more. 200 times more what I'm having in 1,000. So leverage is a double-edged sword. It can increase gains very, very fast. But if you're in a losing position, it can also increase the losses. So I need you to understand it's basically being able to trade a bigger position or being able to have a bigger position than your account balance, 200,000. So increasing your leverage magnifies both gains and losses. I hope I've made sense, Mr. Mike Cotto. Someone had asked about leverage. So I have 5 more minutes. So any other question? Have I made sense? Can you talk about yes? Good. You have understood. So anyone else? Let me to everyone. Any more questions? So I need to ask any more questions before I'm done. Any more questions? Margin, I said, is the deposit required to open and maintain a position. So we'll do this practically. Don't worry, it can be free or used. So when you have open positions, we have used margin. This is what we are able to maintain positions. When you're seeing those trades running, negative or positive, but as long as they are running, that is what we have used margin. Whereas the free margin is the amount available to open new positions. Free margin is the amount available to open new position. So with $1,000 margin balance in your account and 1% margin requirement to open a position. So we have used and we have free margin. Used is what is running the positions, and we have free is what is available to open new positions. So it's very, very important for you to understand that. So it allows the trader to leverage the account more. So if you understand leverage and margin, we'll do this practically, because for you to understand leverage and margin, you have to really, really do this practically. Spread is not hard. I had said it's the difference between the sell and buy quote or the bid and offer price. For example, if Euro USD reads this, the spread difference is 1.33. Also, this one we're going to do it practically. So I have less than 4 minutes remaining. Any other question? So this is our Q&A. This is our Q&A session. Like roughly how much do I have to deposit in a trading account? So for you to be able to start trading, you need at least, okay, the minimum usually is $100, but I will not now. Usually you require $100, but the best would be $250 to $300. At least $250 to $300 comfortably. You're going to make an extra 2 to 3% on a daily basis. That's roughly how much? 10% of $30, $15, 5%. So we are talking of $10 to $20 on a daily basis. So, but I need you to understand, the more you have, the more you make. So if you have lower amount, say you're starting an account with $200 or $250 that we had seen, so you have to use less risk for you to make money, so that you can be able to build the account. Remember, we are building this account over a period of time. Okay, any other questions? We are almost done. So for the broker, we'll be telling you which broker we use, who has very good spreads and of course liquidity and all the rest. So Maureen will be taking you through that tomorrow. So for those guys who will be joining the class exactly by 11, we'll have another 1 hour or 1 hour 40 minutes, 45 minutes. 90 minutes is enough. But tomorrow I'll just tackle fundamental and technical analysis, how you apply. I'll also introduce you to the trading platform, so to be more technical. So today was more theory because it was more of introduction to what forex trading is. So make sure you don't miss tomorrow's class, because tomorrow now I'll introduce you what is technical. Let me write here: technical analysis, fundamental analysis, and price action. So that's what we'll be handling tomorrow. So tomorrow's class and opening an account, start trading. Tomorrow's class and opening an account to start trading, so that now you start familiarizing yourself with what it is we do all about. Then you'll be given assignments every week. So at least what we have done today, you're going to get a PDF. You answer those questions, then we'll be able to see if you have understood it. So thank you very much for your time. Let me now stop the share and then we can call it a day. Thank you very, very, very much. And I wish you a lovely, lovely afternoon. So unless we have any questions, I think we will end our class there. So my name is Victor, and it's been a pleasure taking you through this training, and I hope you have had a wonderful time. So thank you very much, and have a lovely, lovely afternoon. Bye. See ya. So goodbye, and I hope you've gained something, and I hope you become the best trader you can be. So you're welcome. Thank you very much, Kamau, also, and have yourself a lovely, lovely afternoon. It was an honor and it was a pleasure.